Here, Metair has produced a satisfactory result for the half year ended June. 143 cents per share as the headline earnings. That's unchanged from the previous period. Group revenue, excluding Hesto revenue, we'll come to that later, increased to 2.46 billion rand. In the Power Lunch studio in Johannesburg is the CEO, and that's Theo Locke. Theo, when I see the word satisfactory, I automatically think, hello, something's gone wrong here, because satisfactory, I heard yesterday from somebody else, and their results weren't particularly good. Were you satisfied with the period?
Yeah, I think we're pleased with the result. We would obviously like to bring growth to the market, but we've had a sustained earnings at 143 cents. But what pleases us particularly is the niche improvement that we had in the Romanian market, in a very difficult European market. And then, as you know, we're all affected by the labour environment at the moment, and therefore we took some strategic decisions to increase working capital. So the combination of that, yes, we knew that this year is going to be end of our 3-year wage agreement negotiation, that we got to be cautious of the year, but we found a nice little pocket of niche excellence with our Romanian acquisition.
Which of course extols the virtues of diversification, Theo. But tell us a little bit more about the labour problems that you've had. I mean, it's everywhere. Almost every industry is affected, and particularly vocal have been the people in your industry, in the automotive industry. What's the latest state of affairs?
The latest state of affairs is, as we're sitting today, there's a National Executive Council meeting going on at NUMSA, where they're considering the latest offers that was made in a three-year wage agreement deal with the unions, where they offer a 10% increase for year one, and an 8.5% and an 8.5% for the 3 years following. And they're considering that today. And then we are in our second week of our customers being on strike, and as we stand today, even our businesses are on short time, and we're coming out of our wage agreement peace clause by the end of tomorrow afternoon. And then the possibility for us is to continue negotiations next week, but in theory it could be possible for us as a business to be in a strike position as from next Monday.
How much is that going to cost you if you are in a strike position? I mean, on a daily basis, and have you got a contingency plan set out?
Yeah, very much so. I think from a contingency plan, we already started in August last year. We saw some port delays in the harbours because of some major or minor labour actions in the harbours and the port authorities. They also planned some upgrades. So already a year ago, we've decided to increase our working capital by additional 7 days. So part of our mitigating factor is to build up about 1 week to 10 days of finished goods stock. So at least when our customers go back online and start producing, that we can supply them and therefore minimize the continuation. And then we won't be living in reality if we didn't know that we anticipated the week of a sort of a 3 to 4 week delay this year because of labour action, yeah. And that was planned into the system. And that could mean that this year compared to last year is static. And that's why we always said, you know, the industry had the potential this year to have 10 to 12% growth, but because of the end of our 3-year wage agreement, that it's more realistic to think that we're going to come up with static volumes or a slight increase. And at the moment, we're still optimistic that there won't be prolonged delays in our industry. And prolonged for us means anything more than 3 to 4 weeks will be seen as unplanned and will be seen as prolonged.
It's very sad that a CEO like yourself should have to worry about these sort of things, but as you quite rightly and philosophically said, this is a fact of life. Let's have a look at your operations now. In original equipment, first of all, you say here that local vehicle production during this period under review, the last 6 months to June, was not directly affected by any labour action and increased to almost 273,000 vehicles produced. So not a bad result.
Very good result, and I think it comes from the security that our government has bedded down a very, very important automotive incentive program called the Automotive Production and Development Program. It's been promulgated and legislated till 2020. It brings a lot of structural security in 60% of our business that derives from the OE, and it makes South Africa a very, very good manufacturing destination for vehicle manufacturers that target the export market. So it's fantastic macroeconomic security in this industry for the next 7 years. It's fantastic.
What about aftermarket, non-automotive and exports as well? I was chatting to a short-term insurer yesterday, Theo, and he was bemoaning the fact that the rand has gone to pot and that some of his parts that he has to receive claims for have gone through the roof in terms of price. What about your aftermarket performance? How's that been going?
You can see our aftermarket is up 19%, especially our aftermarket exports and local aftermarket sales. That's very significant and good for us. Plus the contribution from that is up by 9%. So we see that as a growth market, and especially the good vehicle sales of the last 4 to 5 years supports our annuity income from those markets. And our annuity income only comes to us after 4 or 5 years because we tail end of the product. So we're very upbeat about the potential in the aftermarket business over the next 3 to 4 years.
Tell us quickly in the last 45 seconds or so, Theo, if you would, about stop-start, because I'm not being unkind now or being obvious, but it has been a stop-start affair. I remember hearing about it ages ago. What is the current state of affairs? Because it's an exciting product.
Very much. It's driven by legislation in carbon footprint reductions, especially legislated to start in 2016 in Europe. And we've managed to produce our own internationally approved product. And we've moved from our first local OEM in the use of our product to the second one that will start at exporting with the new local vehicle launch from 2014, and it's a big part of our expansion program in Europe, especially in Rambet, where we've put in a new facility that's able to produce between 600,000 and 700,000 Star batteries when the market requires it as from 2016.